Happy New Year, everybody. This is Scott Chan with the video for January 7th, 2010. Earlier this week, China, who trails behind only the US in terms of energy consumption, announced plans to actively compete for and secure for itself global energy and material resources, pointing to rising demand from within the country and to rising commodity prices in the upcoming years. Now, this only confirms what we have long suspected, but fast rising prices could have adverse effects on other economies that don't have the growth to absorb the inflationary pressures created by emerging markets' demands. But for the emerging markets themselves, such as China, the increasing demand for, quite literally, the fuel that drive their growth is a bullish sign for these countries' prospects. We are already seeing the China factor in the rallies in various commodities. For example, copper is at its highest price in nearly a year and a half. Oil, meanwhile, has more than doubled off its December 2008 lows, even though energy demand here in the US has remained essentially flat. And copper has rallied since its bottom despite weak housing construction activity in the US. In other words, it's demand from China and other emerging countries that are mostly driving prices up. China grew 8.9% in the third quarter of 2009 and claimed the spot as the fastest growing economy in the world. The second fastest was India, whose GDP growth was 7.9% in the same quarter. Speaking of India, according to a top economist in the country, it could challenge China for that title as the fastest growing country as soon as 2014. So that's going to be another big hungry mouth to feed in terms of natural resources. That's it for today. Thank you for watching, and join us again tomorrow.